become a member on this platform, especially the fact that he has been here more than once, and yeah, he's now a family member. You're most welcome, Mr. Dedan.
Thank you, Mr. Mukaras, for having me tonight.
It's a pleasure having you once again.
Thank you.
Yeah, and kindly greet our viewers, then we shall get into...
Yeah, greetings our viewers. Join us as we go through this interesting topic.
Okay. Actually, just to start... from last week, we were looking at taxation of individuals, and we left out an aspect in taxation of companies with people who have records and people who don't have records. I think we can pick it up from there, because I think somehow some people didn't understand the concept very well. So we pick it up from there, and then we shall connect with companies. Yeah.
Okay. Yeah. Thank you very much, Mr. Mukaras. As we said last week, we are discussing about a topic called the taxation of individuals.
Yes.
And individuals, of course, are categorized differently, but what we are saying was specifically about presumptive tax.
Yes. And
we said this is the taxation for small businesses, for individuals. And to be specific, these are people up to 100, they make a turnover of up to 150 million. So we are looking at a turnover from 0 up to 150 million. Turnover in simple terms is about the sales one has made in 12 months. 12 months can be in the normal financial year. Normal financial year, we are looking at the period that the government uses, which is July, from July 1st up to 30th June. And there are other people who actually have a different accounting period, which we actually call a substituted year of income, that for them, instead of July to June, their period is actually January to December.
Yes.
So to run through it a little faster, we said that any amount from 0 up to 10 million, there is no tax.
Yes.
Yes. Then beyond the 10 million, there are different brackets. And the first bracket, we said that if you are between 10 million and 30 million, your tax, if you have records, it is a 0.4 of the difference between 10 and 30.
Yes.
But if you don't have records, then that is a broke figure, 80,000. Yes. Then the other following category, you go now from 30 to
30 million.
30 million to 50.
Yes.
Now from 30 to 50, we are looking at, if you don't have records, they are saying pay 200. But someone who actually has records, we are looking at pay the 80,000 plus now a 0.5 of the difference. Now the 80,000 is from the other second bracket. The second bracket is the one of 10 million up to 30 million.
Yes.
Now pay the 80,000 plus a 0.5% of the difference. What does this mean? That, for example, if I'm making a turnover of 40 million, it means I'm above 30, but I'm also below 50 million. The implication in terms of figures is that, one, I will pay the 80,000, which is the maximum, up to a bracket of 30 million. Then above that, the amount above is 10 million. So you compute now 0.5% of the amount, which in this case is 10 million. So your total tax will be 80,000 plus a 0.5% of 10 million. That becomes your total tax. You get?
Yes.
Now, the next bracket is now where you are saying, do you have records or you don't have records? The one who does not have, the one who has records, will now go to, you're looking at 200 plus now a 0.6%. But now the next bracket we are talking about is the one of between 50 and 80 million. That if you don't have records, you're now going to pay, if you have records, you are going to pay 200,000 plus a 0.6 of the difference between now 50 and 80
million. Yes.
Now, I remember saying here on this forum that the maximum one can pay when you are in a presumptive tax bracket, which is up to 150 million, is 900,000.
Yes.
That's the maximum. What am I saying? That if I don't have records and I'm in this bracket, my turnover, my sales are up to 150 million, the maximum I can pay to URA or to the government is 900,000.
Oh.
I think that's the climax. Because what I was trying to tell our people, quite often we fear taxation.
Yes,
But just imagine, if you have made your sales of 150 million, but then the maximum tax is only 900,000, can 900,000 put you out of business? That's the point I was trying to explain more than even the others. That quite often we run away and actually say that it is taxes that are actually pushing us out of business.
Yes.
But in my view, as a tax student, a tax expert, in my view, when you look at the 900 as a tax out of sales of 150 million, to me, really that shouldn't be an issue to push you out of the business. Yes.
Okay.
Yes.
Well, let us get to taxation of companies. And according to you, what is considered as a company?
Well, a company, we have different companies, but here, to be specific, we are looking at business companies.
Okay.
And according to URA, we are looking at companies which have been incorporated here in Uganda, or the management of the company takes place here in Uganda, or the management, the incorporation, and then the operations are here in Uganda. That's a company that is in Uganda. But of course, there are resident companies and non-resident. There are other international companies which actually have businesses here. Again, but now for those ones, non-resident, you realize that management will be somewhere else. These companies are incorporated somewhere else, but they operate in one way or the other here. So they have a branch in Uganda, but they are not local companies. They are not incorporated here, even though they are operating from here. Yes.
Okay, so now how are these different companies taxed?
Now, in the first place, when you look at Section 4 of the Income Tax Act, it's the one that guides us as we try to interpret and apply the laws on these incomes of companies, but even for individuals. It says that there shall be a tax called income tax that will be charged on incomes earned by taxable persons. Now, taxable persons, even a company is a taxable person or a taxable entity. You and me, we are also taxable persons. So when we talk about a taxable person, we are not just talking about the individuals. So in the tax language, when you say taxable persons, we are looking at taxpayers. It can be a company or an individual. But now specifically for this discussion, when you talk about taxation of companies, as I've said, the act that imposes tax on incomes of a company is Article 4 of the Income Tax Act. Now, from there, you cannot tax a company before you look at actually the incomes. Because the topic we are handling, income tax for companies, other people call it corporation tax or corporate tax. So depending on where you are reading, if you say corporation tax or
corporate tax,
income tax for companies, or corporate tax, they all mean the same.
Okay.
Taxes charged on incomes of the business. Now, Section 18 of the Income Tax Act again guides us what qualifies to be an income of a business. If, for example, you are in a trading, you go buy goods from Mukwano, go and sell them, that is business. You may be in a consultancy, the way we do consulting and advisory, that is business. You maybe you buy land and actually sell it, that is business. You may be providing a service, that is business. But also, if, for example, you have assets, let's say you have a motor vehicle or you have this building and you sell it, actually that is also an income. It is taxed differently. You have another component under taxation for companies called capital gains.
Yeah.
Capital gains, we are looking at if you have this building, how much had you invested in this building? Then how much are you selling it at? But also the new...
Why then is it referred to as capital gain?
Yes, I'm coming to that because,
Okay.
because why it is called the capital gain is that this is a capital expenditure.
Okay.
If, for example, you are buying a truck, the truck is not a revenue expenditure. Revenue expenditure are the day-to-day expenses you incur while earning your incomes. But capital expenditure are these other assets you buy that will help you in the generation of an income, and they benefit the business for actually a longer period, more than 12 months. So we are saying that even when you have your asset, we call it a business asset, and you sell it at a gain, the gain should also be included in your business income and taxed. So before we discuss the details of taxation of companies,
yes,
we start from understanding what do you tax?
Yes.
You tax incomes of the business. But then how do you tax incomes of the business? We look at what we call chargeable income. Now, chargeable income, which falls under Section 15 of the Income Tax Act, guides us that to get chargeable income, you first get the gross incomes. Gross incomes, I'm meaning, now gross incomes are, again, we have a different section of the Act, which is actually 17, Section 17. It says that you look at all incomes earned by this company from whatever source. It can be even incomes earned across the border. That's gross income.
Yes.
Now, when you're looking at gross income, it can be, if you have rental, rental I know is taxed separately, but it is also, if you have an income, the government through URI, they are interested in knowing how much rental have you earned so that they tax it. But
as rental tax.
Yes, as I know, we shall discuss rental.
Yes.
I don't want to go into the details of rental.
Yes.
So our focus will be other incomes, specifically the usual ones.
Yes.
If I'm in business, I'm trading. If I'm in business, I'm in consultancy. If I'm in business, I'm in all these sorts of businesses. How am I taxed? So I'm saying, if you have business A in Chikubo, you have business B in Iguru, you have business C the other side. All those, if you are one company, then you combine them. These businesses may be different. I can have a company, I have consultancy, but I also have trading. You get my point?
Yes.
Or I have also sold my asset, what I termed as a business asset.
Yes.
So when I'm to declare to the government through URA, I gross up, I add all of these. Then I show that these are my gross sales. After getting my gross sales, then again, Section 15 guides us that when you get the gross and then you subtract allowable deductions or allowable expenses, then you arrive at what we call, in the layman language, we can call it a profit. But in the tax language, we call it chargeable or taxable income.
So in other words, each time I hear taxable income, then that is a profit.
Ideally,
Okay.
a profit from the perspective of a taxman. Yes, I'm specific because
Yes.
the profit that a financial accountant would consider is different from the profit that a taxman considers.
Okay.
So when you get the gross incomes, you subtract
Yes.
the allowable. Why do I use the word allowable? This is what the Income Tax Act allows you to deduct as expenses. That there are other expenses. If I can give an example, if I have a company and I pick $1 million and I go and buy a Gomez for my wife, yes, it is an outflow, money has moved out. But when URA is looking at my expenses, then that cannot be an expense because it is an expense of a personal nature or domestic nature. I'm just doing this for issues outside the business. So in reality, you realize that the allowable deductions are actually expenses incurred in trying to earn this income So if it is an expense that does not contribute to the earning of the income
Yes.
that you are declaring, then according to the Income Tax Act, that is not an expense.
Oh.
Yes. Now, when you go to these expenses, or what we call the allowable deductions, I
Yes.
want to go into somehow a detail so that we appreciate, because these are things that we are struggling with.
Exactly.
That every business person would want, in the first place, to inflate these expenses so that there is no tax or there is minimal tax. Now, the law comes in to actually guard against the inflation of expenses. Under normal circumstances, if we had a way, I'm talking now as a business person,
Yes.
business people had a way, everyone would declare a loss. and the moment you have declared a loss and it is a genuine loss, it is actually one of the deductions that is allowed. That if you make a loss in this year, then that loss in the coming year, you will subtract it from your chargeable income. So if we had a way out, if taxpayers had a way out, they would always inflate. So the law comes in to actually regulate our behaviors as because I told you last time that a tax is a cost.
Yes.
So by all means, given a chance, people would want to minimize costs.
Yes.
So people would want actually to minimize taxes. Now, the other expense is that as you try to compute your chargeable income, if you are in this normal trade, all your purchases, whatever you have bought for sale, ideally, this is part of the deductions. Because you have spent on items that you have actually sold. In accounting, we call it is put under cost of sales. That as I try to sell these, what did I incur to actually make the sale? I incurred by buying. So, under normal circumstances, as long as a taxpayer can support with documents that I bought this and that, then it should be allowed. Now, on that I must state that now government is saying that if you are buying from someone who is meant to issue an e-receipt, an e-invoice, we talked about IFRS last time. You are buying from Mr. Mukaras, who is meant to be issuing tax invoices. And for you, you have not been issued that. The moment you get to know that, then they won't allow that expense or that purchase. Because it means the other person you bought from did not declare or acted illegally. That as you buy, this person is meant to issue an e-invoice.
Yes.
So if the person has not issued, it means on the side of URM, you may not successfully support the purchase. Yes, I want that one also to be taken clearly. The other important expense that we normally have, and which it disturbs most of us, is what we call salaries. As you look at businesses, especially companies, most of us, the biggest expense we have is salary. But then, as I said, that every expense you want to deduct from your incomes, it must be supported. The only and easiest way to support your salaries is declaring them through pay as you earn. So if you have not declared them, then the taxman will not allow that as an expense. Even when you try to put it in your returns, at a point when a taxman is doing return verification, then they will say, no, you are saying you spent 100 million as salaries, but when we check your pay as you earn return, there is nothing. So this, we don't allow it. I must also state that business people out there, those who have tried to follow up, one of the queries they have received of recent is about the mismatch between the pay as you earn declarations, which are done monthly, as compared to income tax salary deduction declared. What am I saying? That if you sum up your pay as you earn declared in 12 months, if it amounts to 200 million, and income tax salary expense declared amounts to 300 million, the taxman is asking you, you are actually deducting much more than you paid. Ideally, what you paid went through the pay as you earn return, and The moment the two are not agreeing, these are some of the queries the taxpayers are receiving on a daily. Why did you declare this side and you declared a different figure on the other side? On the same note, pay as you earn, I must bring in an issue of NSSF that taxpayers should appreciate that an employer contributes 10% of the gross income earned by staff. So URA today, when they are doing return verification, they actually go on and check. If you are saying you paid 250 million as you pay as you earn all your employment expenses through the pay as you earn, then the question is, did you also declare 10% as an expense, as a contribution to NSSF? The moment again the two are varying, then you hear URA calling. Now URA today, I think I must applaud them because they actually call and send messages.
Okay.
Please, we are seeing this mismatch. Can you come and we talk about it? I've had a chance, of course, to work in these issues of tax for around 10 or more years. I know at one point they would find this mismatch and straight away assess. Assess means that the difference, they charge you 30% without an explanation. But the URA today, actually they send what we call an advisory notice or message. They tell you, in some cases, we are seeing a difference of maybe 20 million between NSSF contributions and then compared to your pay as you earn deductions. Can you please come and explain? So if you explain and they are satisfied, they are okay.
Will they still request for a backup of documents? Or it is now verbal?
No, it can't be verbal. Verbal, you normally use verbal explanation in supporting documents. What am I saying? That you have already given them your monthly pay as you earn returns. So they already know, they can sum up and know in a year you spent 300 million. So what they expect as an expense as employers' NSSF contribution should be 10% of 300 million, which should be 30 million. So in a situation where you have 20 million as NSSF contribution by the employer, then the taxman is asking, you are saying you paid 300 million to your staff. How come the contribution to NSSF is actually less? What happened? So, one, already they have the returns. So supporting return employment expenses, you have already supported. But then this other side, can you give an explanation why you are declaring 20, not 30 million?
Now, one thing I'm seeing is there is no way you can deceive the system. And let's take a short commercial break. When we return, we shall continue. We are continuing with taxation of companies. Stick with us. We are taking a short commercial break.
Family TV, enriching lives.
Welcome back from the commercial break. This is Family Hour, and we are looking at taxation of companies. We are continuing with our discussion. Just in case you've just joined us, or in case there is someone you want to follow this conversation, kindly get to send them a YouTube link. We are streaming live on YouTube, but you can as well be part of the conversations as you send in your comment on our other social media platforms, that is Facebook and X. Before the break, Mr. Dedan, you had actually broken down the aspect, and we are now getting to now the company tax as the tax law, or the tax act stipulates it.
Yes. Yeah. To go back to where we had reached.
Yes.
I'm just saying that according to the Income Tax Act.
Yes.
When we talk about taxation of companies, which I said it can be called company income tax, it can be called corporation tax or corporate tax. Taxes. Now, it is about your gross income.
Well, actually, that very point, there is someone who is asking for an elaboration on corporate and non-corporate.
Yes. Non-corporate, we are looking at now me and you, the individuals.
Okay.
And for individuals, as we had discussed last time, that it depends where you are placed. One, if you are in formal employment, purely it is deducted before you earn through a pay-as-you-earn system.
Yes.
That is one way. The other way, that if, for example, you are earning rental, which rental we shall discuss, that after giving you the annual threshold, you are charged 12% of what you have earned. If you are in business, then you earn, spend the business expenses. What remains, it is again taxed using the same brackets as applied to formal employment income. The brackets are the same. Where from 0, if you are earning 0 to 235, where you are not charged anything or a zero rate, then from 235 to 335, you are charged 10%. Then from 335 to 410, you are charged 20%. Above 410 to 10 million, you are charged 30%. Then people who are in the category above 10 million per month, they have an extra charge of 10%. That's what brings us to the fact that it is up to 40%. You get that as long as you are earning above 10 million per month, for you, in fact, you are the amount above 10 million is charged at 40%. Yes, that is now how individuals is handled.
Yes.
But for a business, as I was saying,
yes,
you are looking at gross income, which I said that gross income, Section 17 guides us. Section 17 of the Income Tax Act guides us what should be included in the gross income. These are worldwide incomes, as long as you are a resident company in Uganda. But also, after looking at worldwide incomes or gross incomes, then you deduct what we call allowable deductions. Section 22 of the Income Tax Act again guides us what are allowable deductions. These are expenses and losses incurred in the process of earning an income. Ideally, those are allowable deductions. That these are expenses that a taxman, in accordance with the tax law, agrees with. That yes, these are business expenses. What you incurred in trying to earn the income, but also the losses that are made. That's what we call the allowable deduction. So if you get your gross income, then you subtract your allowable deductions. You arrive at what we call the chargeable income, which I said that is in accordance with Section 15 of the Income Tax Act. Then you charge a tax of 30%. When you hear talking about corporation tax, the rate is 30%.
Standard for all companies.
For all companies.
Okay.
That irrespective of how much I have made, as long as I have arrived to what we call the taxable or chargeable income, then this is charged at the rate of 30%. A simple example: if I have made a chargeable income, if I've made $1 billion in terms of sales, and then I have spent 900 million, that leaves with me a chargeable income of 100 million.
Yes.
Now, the tax applicable on the 100 million is 30%. So the government needs 30 million from me, and then me I remain with 70 million. Ideally, that is the taxation for companies. But if I'm to go into the details a little of these deductions, that we must appreciate, there are a number of provisions that we normally don't mind about. For example, the law says that if you are buying things, if you are buying items from someone, and they are above 5 million, and this person is not registered for tax. Not registered for tax means this person does not have a TIN number. Ideally, that is not allowed as an expense. What am I saying? That by the time you buy from someone 10 million, you should be sure that this person actually has a tax identification number, that this person is a registered taxpayer. Otherwise, why should someone be in business and earning lots and lots of money and is also not making a contribution to the government? Now, the other expenses that we can look at, if for example you are in business and you are supporting, let's say, charitable entities. Charitable entities are also defined, but the point I'm trying to bring up is that you know, many people in trying to manage tax, they say, if I wake up and contribute to a charitable organization, that is a deduction. No, the government is clear, the law is clear. They are saying that what you have contributed to the taxable entity, it should not be more than 5% of your chargeable income. That they must put a cap. Why are they putting a cap? They wouldn't want all of us to disguise that we are actually donating, yet we are not paying taxes. So as we try to donate, which is good, but then we should do it within the means. Okay. We need to first test and see, is this 5%, is it above, or is it below? You get? Now the other issue is that, for example, people who deal in international business,
yes,
every now and then they are exchanging. As you exchange,
like the multinational companies.
No, even the locals, the locals. That I can give an example. If you are buying things, let's say, for example, we import fuel from Kenya.
Yes.
So if you are importing fuel from Kenya, you actually pay in dollars. A dollar today is actually at around 3,960. But 2 weeks ago, it was around 3,700 or 800. So if someone bought items last week, when a dollar was at 3,800, and today the person is paying when a dollar is at 3,900, automatically the person is making a loss of 100 per dollar. Now that we call it a realizable loss. The loss that you have actually incurred. There is an unrealizable and realizable. But when you have incurred a loss, when it is a realizable loss, then this is also a deduction.
Okay.
Yes, so we must differentiate between have I realized this loss or it is unrealized. Unrealized is that you are estimating to make a loss in your books.
Just estimating.
Yes, because let me bring it clearer.
Yes.
That, for example, I know I bought things on a credit when the dollar was at 3.8.
Yes.
Today the dollar is at 3.9, and I haven't paid. I will pay next month. So if I'm to do my reporting today, I will report my liability, what they are demanding me, at 3.9. So at 3.9 it means I've recognized a loss of 100. But this 100, because I have not paid yet, it means I haven't incurred this loss.
Yes.
I'm just providing for it because this is where the dollar is. So the taxman is saying, no, this one, even when you are anticipating that the dollar may keep going up, but we are not allowing it now.
Oh.
Yes. The other important point that I must bring up is that as we look at the deductions, quite often we want to look at everything that has taken money out of our pockets to call it a deduction. The taxman is saying, no, that's why I'm using the word allowable deductions. I will use an example. If in a business you are penalized, last time we talked about one of the consequences of non-compliance is penalties.
Yes.
If you are penalized for non-compliance, the penalty or the fines and the penalties are not a deduction. What am I saying? That even when you have paid out, it is a cash flow. I mean, it is an outflow you have paid. But for tax purposes, it won't be an expense. If, for example, if you look at, for example, at income tax,
yes,
it is an outflow. But for computation of income tax for companies, you cannot now get the income tax paid and you include it under your expenses. No, that treatment is not actually right. The other bit that is, again, an issue that is common as we look at taxation of companies, which have also caused many businesses problems, that when we are filing these returns, income tax returns, specifically for companies in this case, there are two important statements that we use. There is what we call an income statement and a balance sheet. Now, a balance sheet, an income statement brings issues to deal with what you have earned and how you have spent and what is remaining, which is ideally your profit. Now, quite often, that statement of an income statement has a balance that we pick from the previous year. There is a provision for that balance. Now, I'm trying to highlight some of the areas where we make mistakes in trying to file and actually cause us problems. That the moment you have a wrong carried forward retained earnings figure, you are able to say, okay, where is the problem? Last year you reported that you closed with a profit of 100 million. How come in the new year you are putting 50? Where did the 50 go? That is a question. The other important point that I have seen recently, it is actually in the balance sheet. That many people have always had loans, and these loans specifically, they are called due to related parties. These are not loans from the financial banks. If you have to say, I have a loan from the financial bank, for example, it affects two statements. That one, you should have declared interest in your income statement. But also, this should be a loan that you acquired to use in the business, not a loan that you acquire to go and do your own home issues and then you want to come and bring the interest as an expense. The taxman will ask you, where is the loan agreement? So the loan agreement should be between a financial institution and the company under consideration. But if it is a loan agreement that is between Mukaras and the bank, then that loan is an individual loan. And the interest should not cross over to a company income statement. Let me hope I'm clear on that.
Yes.
That the documents must be company to the financial institution, not individual to the financial institution, yet you want to claim this interest in the company income statement. Now,
so can't I be given an opportunity to explain this? That, okay, what exactly happened was that according to this loan, I had an emergency, and probably as an individual, I had collateral that would enable me acquire this loan. And for the company, it would belong. But that is why. But when I got this money, it was now brought in the company.
That is a very good argument, and actually we always meet the same. But if I'm to look at it politically, one, you are borrowing as an individual. The agreement is between you and the company.
But and to bring the money in the company.
Yes. Now, how did the money flow from you to the company? That's where normally we get it wrong. Was there a resolution registered by URSB, Uganda Registration Services Bureau, to say the director or the business owner, because he has security and the company does not have security, is going to borrow this money and then it is plowed back into the company? Now, that calls for, one, a resolution, but also the money should be transferred as long as you have a resolution. Then the flow, the money being transferred from the bank account to your account, then you also transferring your money from your individual account to the bank account of the company. That flow should be clear, that when they bring statements for the three entities, and for the two, you and your company, then the two should actually say 100 million came from Stanbic to Mr. Mukaras's account. Then the 100 again was transferred to Mukaras and Sons Limited. Yes, quite often when URI is doing this audit, they are human beings like us. They understand when you explain. But where we get it wrong is on the documentary evidence. That I want to convince URI that actually I borrowed on behalf of the company and put in money. And we do these things in business. We do them. But as long as they are not supported, then no officer will be willing to listen to your words because anyone can claim that. Now, relatedly, the other issue that has become a big point today is now another category of loans called related party loans. It is also provided for in the balance sheet as we declare these things to URA. Now, the moment you have put it,
yes,
URA is interested in knowing. Related party, if I can explain it, this is money or loans that have been borrowed from people who have a stake in the business. Maybe people who have a stake or people who are related to those who have a stake.
For example, I mean, trying to understand it, I have Raymond there as part of the partners, the business partners.
Yes, please.
So Raymond borrows the money on behalf of the business and brings it in the company. Is that what you're trying to explain?
Not necessarily. It may be his money. He has not borrowed. But the company is struggling.
Okay.
So he gives you
money. He
money.
gets into his pockets.
Yes, he gives you the money.
Okay.
Now, where we have been beaten hands down by URA as we try to represent taxpayers, URA is saying, if you know, indeed Raymond put in money in the business, one, show us how money moved from Raymond's account to the company's account. That's one. Two, show us a resolution that says we sat and agreed that Raymond gives us money, let's say 100 million for a specific, for a year, for example, with interest or without interest.
Isn't that complicating things?
But on the side of the taxpayer, it looks complicated. But me, where I see it, I try to understand where the taxman is also coming from. That all of us at one point we shall claim that we have actually put in money in the business. The most interesting bit, URA will say, okay, Raymond gave us the money. Let Raymond first give us his statement. Now, most of us, we don't want to give out our statement.
Yes, of course.
Reason is clear. That because what goes around our statement is not clean. So, if you say Raymond gave money to the business, which is okay, one, let him first produce his bank statement. Now, that question alone becomes a thorn in the neck. How? Wow. Because Raymond, you say, if I give URA my bank statement, what about the other transaction? Won't they now come after me? So if you cannot now support that actually money moved from his account to the company account, then it means what you are claiming is
so
not
what if I look at a situation where Raymond doesn't have any bank account, he keeps his money in his home. So we just had an agreement somewhere, he wrote somewhere, we didn't even seal this with URSB. We just wrote somewhere, he signed, we stamped, and I keep this document. Can it be allowed?
Depending on the officer handling, but under most circumstances it shouldn't be allowed. Why? Even now when there is a query, you can go back and actually sign and stamp.
And you backdate?
Yes, you can backdate. As long as it is between you and Raymond, you sit together at office. It is a matter of rotating the stamp and say 2019 stamp. So what they want, if you say one of the directors or shareholders rent the business, then there should be a resolution. Registered. The moment it is registered, then you cannot play around it because they can search and know. You cannot give them a resolution from NASA and they accept. Because URSB is really a government entity that they can coordinate, collaborate, and know if this is indeed a resolution that was registered or if it is from NASA. You get the point? So, quite often, the moment they go, when we are arguing just for the sake, for the start, we feel we actually have strong points to put across.
Of course, you have these arguments.
But when you get into the details, then the taxman will take you step by step, as people always, process by process. But at the end of it all, you realize that you're actually on a very weak position. One, if it is true that you put money in the business, the question is, you who is saying that you rent the business 100 million, you as an individual, how much of a tax have you paid in this 1 year? If you have not paid the tax and you actually have the capacity of having 100 million, possibly you are involved in money laundering. Two, you have a business that you haven't declared to the URA. So by you producing your bank statement, URA now gets to a point that they are interested in, oh, this is the Raymond, a man who has actually 200 million on his account. So the question is, justify that you actually earned this money. Because if you earned it through business, then it should be clear. Remember, you can only earn as a shareholder from business through a dividend, which dividend is charged 15%. So you cannot say they paid me dividends. The question is, did you actually pay
the 15%?
The 15%. Did your company deduct the 15%? If you say, I have been employed by MTN, it is simple. MTN must have been declaring you as part of their staff. So if you have worked for 10 years, really, and you are earning good money, then it is okay to have even much more. You get? But if you have never paid even a salary of 5 million in the last 2 years, and you are the one lending a company 200 million, where are you getting this money from?
I inherited it.
Of course, we always have all of these arguments. But at the end of it all, when we go step by step, we find that they are actually very weak. What I can advise our taxpayers is that let us get into the habit of recording whatever takes place between the business owners, the directors, and the business. Because
and actually very importantly, when you talk about now bringing in issues of resolutions before you can get into an individual transaction, because I think that is very many people mess up there, because you think I have this attachment to the company, so I can easily get into my pockets, I get out the money, invest it in the company. After at the end of the day, it is all rotating around me.
Now, if you look at company incorporation by law, a company, a company is actually an artificial person. What it does not have is the breath. Otherwise, a company is independent from you. The entity concept in accounting. Say a company and the company owners are two different entities. You get my point? So if you are to do any transaction between you and your company, the records must be clear. Because you realize that actually what you are doing may be very right. But as long as you cannot support it, actually no one will be willing to listen to you. So record keeping is a must. Now, the other important point.
Yes. Probably that will be our last one.
Oh, time is running so fast. Now, quite often, when URA is doing return verification, specifically for companies, they try to look at all the information available.
Okay.
They compare this with what you have in your declaration or in your return. Now, if you are someone who imports, already the URA has a record, because you cannot import anything without going through URA. As a regulator. Now, if everything has gone through URA, if you are declaring your imports, your purchases across the borders, then the value should equal to the value that they already have in their SCUDA system. If you imported 100 million, you cannot go and declare that I imported 200 million. Then the taxman will say, no, at least we already have this. That's one point I would want to put across. The other issue is that, remember, you are declaring your value-added tax returns every month. Value-added tax returns, they show your sales. At the end of the month, at the end of the 12 months, URA can actually sum up and know this person has made 12 billion because every month he has been declaring 1 billion. So they expect even you, when you go into your income tax return starts with your incomes, your sales, your revenues. That's where we start from. So they expect, because VAT or value added tax return is giving them a total of 12 billion, even your sales figure should be 12 billion. The moment the two are not in agreement, remember they already have this information back end. The moment the two are not in agreement, that is also another red line.
Oh, wow. Actually, we cannot go beyond this point because time is almost out. But I believe we still have a lot to learn when it comes to taxes. And let us end it at this today, because we are already getting into time for soul moment, and I know it's been a long day. People need to now rest, but we shall start from here next week on Wednesday. Just do one thing. Come back. Don't go forever. You will get all the information you need to know on taxes from Homoza, Raymond, and the entire team. It's a good night. We meet again tomorrow.
Family Hour, empowering families,